What's going on, grinders? I just wanted to whip up, for lack of a better phrase, like a quick little tutorial on how to buy and sell options on Robinhood, and just to break down some of the things you should be looking for while doing so, as well too. So Greg asked about Tesla. He asked about Battery Day, and Battery Day is really all about Tesla. A couple of other companies that Tesla work with as well too, but it's really all about Tesla. So this is your Robinhood screen. Once you type in Tesla, you'll go to your middle button down here. And then you'll just type in Tesla on Robinhood. Or you can type in the ticker symbol TSLA. And it'll pick up Tesla. So click Tesla and you see the price. All right. So just a quick overview. I'm looking for Tesla to hit about like 500 because it's already at 450. All right, and now there's a huge chance that Tesla could go way above 500. 550, 525, or 550, 600. I've even seen some analysts saying $700. But in the games of options, we want to have huge risk management. All right. It's a little bit different from investing, because in investing, you never really lose that money unless your company goes bankrupt. Right. The value of the money can fluctuate, so you could buy Tesla at almost $500, and within a week, that value could go down to $330. Right. But you don't lose the money. You don't lose everything. Right? It's equity. It's not cash. And that's the difference between investing and purchasing something. When you spend and you purchase something, you lose the money. And investing, you only lose equity, right? Because if you don't sell it, what happens with investing is that you can then ride it back up. And if it continues to go past what you bought it for, that's when you start to see profit, right? So that's when investing. I'm a huge investor. But with options, for the purpose of this video, you want to click this little green button at the bottom right hand corner, right? And you want to click the trade options button. So if you click buy, that's going to help you buy a stock, right? But if you press the trade options button, it's going to open the options platform, right? Now, options, I am going to tell you guys, options gonna need a lot of risk management. I normally tell people, do not invest in options any more money than you're willing to lose. So if that amount of money is $5, you do not need to put no more than $5 into options, because options is where you can actually lose the entire $5. This is where a lot of other people don't tell you. They tell you all the glitz and the glamour, but they don't tell you what can go wrong, right? So if you put $1,000 into an option, you have to be willing to lose $1,000 in this option. Yes, you can gain $10,000 off of that same option, right? But you have to be willing to lose it, and that's the big difference between options and investing, right? So back to the option screen. So my call is for, now a call, if you look at the top portion of the screen, you have buy and you have sell. I don't know if you guys can see it flipping back and forth. Let's just forget about selling. You never want to sell. Don't worry about selling. You always want to make sure that the buy indicator is on. All right. So you want to buy a contract to open. Now, when you buy a contract, you are in control of 100 shares. Now, let me go back a little bit. All right. So if we were to buy one stock, not a contract, but one stock of Tesla, and we bought one share, the amount of that would be $449.50, as you see. correct? Now, when you buy an option, you are in control. You don't own, but you are in control of 100 shares. So you are in control of a value. You are in control of a value of nearly $45,000 worth of shares, but for a smaller price. And that's the reason why it's a little bit more riskier, because you don't have to put as much money into it as opposed to if you bought the stock, right? Because you could buy the stock and you don't have to worry about you could worry about losing equity, but you're not going to worry about losing all of it, right? But in options, because you don't have to pay as much, that's where the risk comes in, right? So I know you guys see on this screen here, for a call of $450, is going for $36.83. That does not mean that this contract itself is worth $36.83. Because remember, each contract holds 100 shares, right? So what you have to do is you want to multiply that amount by 100. All right, because it's $36 basically for one contract. For one share in that contract. That's kind of what it's saying, right? Or at least that's how I interpret it. It's $36 for one share in that contract. But now we have to multiply it by 100, and you see how much the value of that contract is. This contract specifically is $3,685. It's because they took this $3,685 and they multiplied it by 100 in order to get the value of the actual contract. All right, so we're gonna take a little step back. Now, if you guys can see where it's flipping, we have calls and we have puts. All right, a call is where you are predicting that the market will go up. So as you see in the middle of your screen right now, Tesla is currently at $449.50. All right. Now, if we thought that Tesla was going to go back, I'm going to go back again and hit $500 again. And it seems like since it hit, it's back on its way to do that, right? $500 again. We would go back to that same screen. We would make sure that buy is highlighted, and we will make sure that call is highlighted, and we're going to scroll up to $500. So this is a $500 call saying that we think that Tesla will hit $500 by September 25th. And this is the reason why you can lose all of the money, is because in stocks and investing, you don't have a time frame. You just hope that it goes up, period, right? But in options, there's a time frame. There's a time limit. It has to hit that strike price, get close to that strike price, by that date. And if it doesn't hit that strike price by that date, your contract will expire worthless. All right. So a week, let's say if someone felt that Tesla was going to hit 500 in a week, and they put in a little over $2,000. Let's say we get hit with Corona Part 2 and we go on lockdown tomorrow, and they shut down Battery Day and everything just goes horrible for Tesla, and it doesn't hit $500. That $2,000 will be zero by the 25th. All right. So my call, if I'm not mistaken, let me make sure. is a I want to say I have a $600. I have a $640 call. So if we scroll up to 640, you see it has a little number of 2 by it. That's because I have 2 contracts of saying that Tesla will hit $640 by September 25th, right? Now, this is when it gets really fun in my aspect, right? Because when it comes to options, you don't need your stock to actually hit your price before on the expiration date in order to make money, in order to make profits. A lot of the profits that you guys see me post, the stock itself, as you see at the bottom of the screen, the share price $449.50. If I post profits from this call here, I can almost guarantee it won't be because Tesla rose from 450 all the way up to almost 650. All right. The key to options is to, as the value of this call goes up on that momentum swing. So let's go back. Let's say you bought this call at $330, right? And let's say you bought a call saying that Tesla was going to hit 450, right? And you bought it at 330. When this stock pops up to 366, from 330 to 366, that's $36 that it pops up. Even though it still has not hit 450, you will be in a nice profit. That's because your contract and your stock moved in the direction of what you called out. This is when it gets really, really tricky. All right? On those momentum swings upward, right? So let's go to the week. All right? So the numbers might change a little bit because we're in a different time frame. But let's say we bought a call at 390, right? And we thought Tesla was going to hit 475, right? If we bought at 390, you can probably cash out right here at 420 with a pretty decent profit, right? The key is that you want to catch the momentum swing up in the direction of what you said. You want to catch the momentum swing up because that's when your profit's going to be there. But as soon as that stock starts to slide down in the opposite direction of where it was going, in the opposite direction of where you predicted it would go, that's when the value of your contract will start decreasing dramatically. And the reason is because you have a time frame. So let's say we only have a week, the 25th, right? And we said Tesla was going to hit 475 or 500. On this momentum swing up, this is like a $75 swing or a $60 swing in basically a day or a half a trading day, right? That momentum swing makes it look like that 475, 500 is very, very likely. So what'll happen is that there'll be more people buying that call because they think it's more likely. But as soon as that stock starts to go in the opposite direction, people's outlook starts to become a little bit more pessimistic. And that set 475, that 500 don't look as likely. So that's when the value of the contract will start to decrease. So the best example is here. Let's say we got in that Tesla on a call at 373, and we said that Tesla was going to hit 550, right? We got in here. You're going to make a lot of money here, right? Because there's a big swing, a big momentum, and it started all the way in the 300s, closer to 350 if anything. And within a couple of days to a week or 2 weeks or so, from the 19th to the 31st, it hit 500. So it's only what, $50 away now? And then the last day, it gained $50 itself? Oh, yes. 550, 600 is definitely likely. That's the mindset, right? But then the next day, when it drops, people's like, let's see another day. It might go back up, and then it drops again. People's like, it's still more than where it was at, right? You know what I'm saying? It could still hit, but this entire time, the value is going down. And then by the time it hits 330, everyone don't believe that Tesla is gonna, or that stock is gonna hit that price. So that's when that value starts to drop dramatically. Me, this is when I get in. When everyone else is selling, Warren Buffett, it's not my quote, Warren Buffett, one of the greatest investors over. When everyone else is selling, that's when you buy. Follow the line. When everyone else is selling and scared, that's when you buy. Whether it's a stock or a contract. Well, I'm not a financial advisor. I'm not a fiduciary. So I'm going to say that's when I buy. Because look at what happens when you play against other people's fear. You go from 330 to 449 in profit. But the key is, again, in the options specifically, you want to, I know I'm kind of going on a tangent, so, I guess you could fast forward a little bit. In options, what you want to do is you want to catch that momentum up. Whether it's one day, whether it's 2 hours, you want to catch the momentum up and you want to take your profits. Close out your contract, right? You want to just close it out. Don't worry about how much more money I could make, right? Just close it out. And my rule of thumb, just so that, no one gets caught up on a percentage or a dollar amount, because you can miss out on profits because you're waiting. You could, if you say I need $100 and you get to 97 and you don't close it out and then it drops, you're gonna be pissed. You held out for $3 more, but you just missed out 97, right? So the whole key is my key is take profits if you get excited. Once you feel that feeling in your gut, in your head, in your heart, in everything, like, take profits. That moment right there, take profits. The moment you take a screenshot, that's excitement, take profits. Because what you don't want to do is have a screenshot of profits, but not have the profits. Because it can move that quickly. All right. Now, the way you close it is, let's say we go back to buying options. All right. We go to the call. All right. Now I know I'm going back and forth, guys. Work with me. Again, this is on the spot. My course will be very, very, very well detailed and organized. But a call is going up. A put means you're betting on it going down. All All right. So I just wanted to say that so you know what it means on the screen. I'm not going to go into it now. But a put means that you're betting on the stock going down. So like we go to a call. And let's say we have, as a new investor, let's say we only have $100. $100. A new trader. Let's say we only have $100 that we're willing to lose. Right? So what you can do, I mean, I wouldn't recommend it on this specific stock and call. I wouldn't do it. But just to give you an example so you have a visual. And it might be better off on other stocks and other calls. But in this case, you can buy a 780 Tesla call for $96. You're going to click that. It's going to open up. You're going to put one contract. And what you're going to see in the middle is you're going to see where it says limit price. You're going to have the bid for 0.92. That is the highest price that someone is saying that they are willing to pay for it. And then you have the ask, which says $1. That is the lowest price that someone is saying they are willing to sell it for. So what you see on the right side is 0.96. That's the middle price in between. That's kind of like the bargain, like the bargain price, like, you know, but whatever they come up with in the middle. All right. So if you wanted to get into this contract immediately, let's say like the trading day is going on, and you notice that Tesla could be shooting up and you want to get in immediately, you want to put in your price at the ask. And you want to pay that extra 8 cents or $8 in this case, because that extra $8, you know, if you get on the right trade, you can get hundreds, maybe even thousands off of it, right? But if you have patience, you can either get in at the price recommended, 0.96, or if you have a strategy and a plan, you can get in at the bid or below that. So let's say, for example, it's trading. The trading day is closed. So I'm going to give you guys an example of what it looks like to buy. Well, I only have $4.24 buying power left. I don't think it's going to allow me to do so. But let me show you what happens if it doesn't. All right, so you hit review. It's going to tell me that I can't day trade, which means that I can't buy this call and sell it in the same day, right? Now you can, I can't, because I'm locked out from day trading for 90 days. But you can only commit 3 day trades and I think 4 or 5 trading days. And I broke the rule. But that's basically what this is telling you. Hit OK. Then it's going to tell me that I don't have enough buying power and I should deposit funds, right? So let's say I do have enough buying power and I have enough for this. I'm just going to hit review again. And then at the bottom of the screen, I'm going to swipe up like any other app. And I would swipe up and I would officially buy the contract, right? Now let's say, as you see right here, I have 2 Tesla contracts. Let's say right here, bought it for $355 and the current price is at $363. And I'm 100% satisfied with my 2% increase, which is $16. You know, I could close that out, put that 16 to something else, and make that 16 grow into 20, and so forth and so on, right? So this is where I could go in. I can hit sell now because I have something to sell. And I can hit one contract and sell one of them. I can hit 2 contracts and sell both of them. I could do it at the market price. I could put it at a price where only this is all I want to sell it for. So say like $4, the highest ask is 370. Right? If I think that Tesla is going to go up, I could put it in a limit sell and just say, look, I'm going to sell it at 400. $400. I got 2 contracts. That's $800. I'm more than okay with that. Right? I'm going to sell out. I'm going to get out, and I'll take that. Let's not worry about how much more we're going to make. Right? Now, another thing that I really, really want to explain to you guys, again, in my course, this is all going to be outlined totally different, is if you click the little bid and ask button, this screen pops up. And this screen is super, super, super important. All right, so you see at the top it says stats. Under it, you have your bid, which we know about that already. Ask on the right, which you know about that already. Now, under bid, we have mark. That is the current price, right? That is the price in the middle of the bid and the ask above. On the right of the mark, you have the previous close. That is where this contract itself, that's the value it was at the day prior. All right, so I think this is the information for Friday. That closing, previous close, that's the price that this specific contract was at on Thursday when the market closed. All right, so basically what it's saying under that is that on Friday morning, when it opened up around 360, in between the day, it went as low as 265, and it went as high as 600, right? So as low as 265 and as high as 600, and it's currently at 363, right? So let's dive into it a little bit deeper. What that's basically saying is, if we go back to the day of Tesla, is that when it started, the closing, you see this line, all this dotted line at the bottom, that's where Tesla closed at the previous day, right? So right here. That's where it closed at on Thursday. So on Thursday, this is where the price was. The price was at 423 when that contract we was looking at was 360, right? When it closed. And then yesterday, Friday, it opened up way above where it closed at, right? So this is probably when it opened, the value was at that 600 number. It was probably at that 600 number because it gained $22 between Friday night and between Thursday night and Friday morning. So that strike price that we was looking at again, what was that, like 680 or something? No, of 780. That strike price looked, as I said earlier, it looked like it was more likely to be hit because Tesla shot up, right? So the value of this contract, I don't think that was the same one I was looking at. I think I was probably looking at mine. Yeah, I was looking at mine. So 640 it was more likely that it could be hit. So the value shot up to 600, right? And that's why I say you want to catch that momentum. You want to take profits, because what happened after the market opened? People started to take profits. People started to sell their shares. People started to sell their contracts because it was more valuable than it was when they bought it the day before. And in addition, quadruple witching. But the stock started to fall. Slowly but surely, the stock started to fall. And it fell all the way down from 448 all the way down to about 432. And that $16 difference in the stock caused panic in the contract. And that same contract went from $600 all the way down to $265 if you see the low. So the high is 600, the low is 265. That 265 was right there at that low part of the day, right? Because it looked like it was less likely for Tesla to hit 640. But as we see, it hit 265 on a low, but the current mark is 363, right? How did it get to 363? Well, that's because after it hit its low, Tesla started to rebound. And that $640 strike price started to look a little bit more likely than it did here, right? Now, the next question comes. Why is it at the same price at close as it was at open, but the contract value itself is not the same price? If it was at $450 at open and it's at $450 at close, doesn't it mean that it can still hit 640? Yeah. But at the same time, remember we have an expiration date. At the top, you see it's supposed to hit 640 by 9/25. So what has happened is a whole day has passed. Time has gone along where it has not hit your price. And in options, you lose value for time. And that's another reason why this screen is so very, very important. All right, now we've been looking at the stats. We've been looking at bid, ask, mark, previous close, high, and low, right? Now what we're going to do, we're going to skip down to the bottom where it says Greeks. Okay, where it says Greeks. Now, you have your delta, and I'm going to break it down as easy as possible just for two of them. All right, just for two of them. You need to know all five. And in our course, we'll get into all five. But just for two of them. Delta, I'll look at it as dollars. Delta, dollars. So how much money am I going to make? How much dollars can I make off of this contract? Right? So what this delta tells you is that you can make 8 cents per dollar that this stock price increase. So if Tesla is currently at $449, right? $449, and I make 8 cents for every dollar it increases. Now keep in mind, back to the beginning, these cents are multiplied by 100, right? So 8 cents times 100 is $8. So now you make $8 for every dollar that Tesla rises, and is at $449, right? So let's say, for example, Tesla rise from $449, or let's say $450 to $460. That's $10, right? It's a $10 difference from $460 and $450. Again, I'm not trying to talk to you guys like you're slow or anything. I'm just trying to make sure that I'm saying everything in a way where, I'm not speaking Ebonic, like stock Ebonics. You know what I'm saying? So that's a $10 difference from $450 to $460, right? Now you take that $10 and you multiply it by the $8 that you can make per dollar. So it's 8 times 10. That's $80, right? So if Tesla in the morning, Monday morning, let's say I got this contract now, right? Tesla in the morning raises $10. I'm going to gain $8 per dollar, which is $80, and you add that to the current mark, which is 365. So 365, or if we're doing it in dollar in like value terms, 365. And we said we're gonna get 80 if Tesla moves up $10, right? Time plus 80 is 445. So that gives you a price to get out at. So we go back here. If I wanted to, I could set my limit sell for 445, and it would sell it automatically there, right? But that's delta. It tells you how much money you're gonna make off of each dollar that this stock moves in the direction, in the direction that you predicted. All right, and it works in the same way in opposite. If Tesla goes $10 in the opposite direction from 450 to 440, you're gonna lose $80, right? So back to the original point of why is Tesla basically the same price at closing than it was at opening, but the contract itself is $250 roughly cheaper? That's because, as I said before, it's time. So we have the delta, right? So that delta is what made it fly up. But then after it flew up in the morning, as we saw, it started to go back down. So we started to lose some of that delta, right? Then the stock started to go back up towards the end of the day. So that delta started to increase back, right? You started to get, let's say in our example, that $80 back, right? But what you see under delta on your screen is theta. In the same way how I say delta dollars, theta is time. Now, in this case, in contracts, you don't make money for time. You lose money for time. It's the reason why I say as soon as you get profits, take it. All right? So in this case, you see theta is telling you that you will lose negative $1.16 per day. Now remember, options we multiply by 100. So that $1.16 is actually $100 and $16. $1.16 times 100. So just for holding the contract a day, you're gonna lose. In this case, this contract for a day, you're gonna lose $100.16, right? Now, that's ironic. It's really, really ironic. It's roughly $100, right? And we know the stock price went up and down, but we know that's roughly $100 that you're gonna lose, right? Just for holding the contract throughout the day. So as you see, now let's go back. At the beginning of when it closed on Thursday, previous close, it was 360, right? That's the value, the actual value of the contract at that time. Now, when it opened up at 600, yes, that's the value, but that's not the actual value of the contract because there's a lot of what they call implied volatility. I'm not going to get into that too much right now. But basically, what that's basically saying is a lot of people thinking that this stock price, that this contract is going to move. All right? So that's the reason why I went up to 600. And that 600 was an inflated value of the contract. Not saying it's not a real value. It's just an inflated value. It was overpriced. It's like if a new pair of, if iPhone 12 come out, right? And at previous close, the iPhone 12 was, I don't know, $1,000. But then because Apple paired with, I don't know, Nike, and they got a Nike iPhone. This Nike iPhone, even though it's the same iPhone, just with the swoosh on it, now costs $2,000. It's the same phone, same contract, same phone, same stock. It's just the value is inflated. It's overpriced. Right? So, at previous close is $360, and that's the real value. Again, the $600 is the inflated value. But let's go back to the real value. Now, if we take that previous close, right, and we take that low. No, sorry. Oh, my goodness, guys. I'm sorry. Again, like I said, this is on the spot. If you take that previous close and you do the math with the delta with all the dollars that the strike price, that the actual stock price has gone up and down throughout the day, like all of this. If you do with the delta and then you add in that 116 for the theta, right? That's how you went from $600, even though this value right here would be $600 if it was here. It's not, because off jump, you've already lost $116 right here. So if this value is 600, right? If this price right here is 600, because it was 600 here, right? This price, this value is 600, and you take that theta of 116 and you subtract that, that brings you down to 484, right? So we have 484, but we still have $484, but we still got a value of $365, right? And that's when all of these other numbers start to get into play, right? But that's the reason why the value isn't the same, even though the stock price is the same. Again, I don't even know if I explained that 100% correctly. I hope I did. But I just wanted to create something on the spot. So yeah, you would just close that out and you would take your profits. If you guys have any other questions after watching this, I know it's probably going to be a little hard to get through this. But if you have any questions, definitely feel free to reach out, and I don't mind getting a little bit more into detail. Okay.